Today, we're going to talk about how to manage your money to avoid becoming poor. Welcome to Season 1, Episode 2 of Achieving Success Through Failure. With everything going on, the rising inflation, which is above 8%, the stock market tumbling, the question is, how are our finances right now? And a lot of people are basically living from paycheck to paycheck. And even more people are actually drowning in debt. Today, we're going to be talking about how to understand your finances in order to manage them properly. Before we even move forward, let's look at how the average American actually does. If you look at all the 52 states, the average salary ranges from $51,000 to $74,000. This gives us an average salary around $63,000 per year, which amounts to $5,200 per month. But that's not actually what they're taking home. What you have to understand is how much is coming out of your pocket and how much is actually being saved. And if you're basically earning but you're spending more, then you're going to be on the negative, and that's where you're going to be sinking more and more in debt. And in order to avoid that one, you have to understand the breakdown of your finances. So first of all, we're going to go to look at a pay stub. Something very boring, something very mundane. But in order to understand how much is coming in, you have to understand the deductions that are also being removed. So in your pay stub, depending on how you're being paid, whether it's bi-monthly or once a month, you can take a look at that there are going to be several deductions. Depending on how much you're earning overall, which tax bracket you belong to. So at $5,200, if you are single, then you would be contributing around $1,100, which is around 22%. If you're married, you'd be in the ballpark of around $600. That's just the start. Afterwards, you have FICA, or Federal Insurance Contribution Act, which nowadays is around 7.65%, followed by Medicare, which is around 2.9%, or $218. And lastly, don't forget your state tax, unless you live in Texas or Florida or Vegas. After deducting all of this, you would be around close to $1,900 of deductions. It would be down to around $3,300. Now, after you've managed to understand how much your net take-home pay is, the next question is, what are your expenses? The first one is going to be your living. Where are you living? Are you renting? Or do you have a mortgage in your house? So the average house price in the US currently is around $405,000. And with this being said, at current rates, if you did place a down payment of 20%, which would be around $80,000 plus closing cost, then your monthly would be around $1,700, paying for principal and interest. Then you have to take into account how much your home insurance is, which could be around between $75 to $150. And lastly, you have to take into account property taxes, which is going to be around another $70 to $100 plus dollars. That would give you a ballpark between $1,800 to $2,000, and that is just your mortgage. Well, the other thing is, if you're renting, your rent's probably going to be around that ballpark as well. You have to take into account the proper budgeting for your cost of living. So that is just the first one. What are your other expenses? Your other expenses includes your car. If you're not paid off, depending on the mortgage, average mortgage for cars is around $19,000, and financing it with how much interest, that could be close to up to between $400 to $700. So what I would recommend is for you to actually write down all of those expenses. What are the necessary expenses that you're paying for? These are going to be your house, your car, your phone, your internet is important, your electricity, and your water. However, a lot of people have other things that go under the radar. These are all the subscriptions that they have. That may include, that's just a monthly budget that goes in. Well, how about going out, vacation trips, buying new stuff, clothes, repairs? There's so many things that you have to take into account, but you have to do your monthly budgets on the ones which are necessary. And then from there, you can take a look, how much leeway do we have to maintain afloat? And what I mean afloat is making sure everything is paid. So what do we have to do? Number one, we have to manage our finances properly. You have to understand how much you're spending, which is on the necessary side. Make sure that you are not going above your means. Maybe you should be on a much smaller house if you're spending too much on your housing, depending on what you're driving, what your car is. These are all necessary things, but there's also going to be a limit on how much you can afford. Number two, cut off on the things which are basically unnecessary. If you are paying too much on multiple subscriptions, or are you buying things on a regular basis which is unnecessary, like buying too much clothing on a regular basis, eating out, maybe these are things that you should decrease. Number three, manage and consolidate your debt. So if you have multiple debts, you have to arrange with regards to your payment. Look at which has the highest interest rate. Credit card debts are very notorious for having high interest rates, and pretty soon what you'll be looking at, if you're only looking at the minimum payment, all you're doing is basically paying them at around 20% per year, which is very high. If you owe them $1,000, that's an extra $200 per year. So you have to be looking at paying off your loans, but much easier said than done. When you're looking at which loan to pay off, you should arrange them on which one has the highest interest rate and try to pay that as fast as you can, because the interest rate will be the one basically keeping you under. So if you have a multiple credit card debt, and if you owe around $5,000, at 20%, that's almost $1,000 a year, which is horrible. So what are your options? If you consolidate your debt through a company which has a lower interest, then you can basically pay that with a lower interest and spread it out. Then you can change how you manage your finances. Other things that you should consider. Well, there's going to be always that long-term debt, which are your mortgage. And as long as you're living within your means, that should be fine. After consolidating your debt, maximize the use of credit cards. Credit cards are actually something which are very helpful. Unfortunately, a lot of people don't know how to manage them. And what they do is basically overspend. If you are actually vigilant on how to use your credit card, put a limit on how much you spend. But you should be able to know which credit card to use in order to get points. When you get points, those are things which are converted to dollar amount. After that one, the next two would be investing. Once you've managed your finances and you're not under and you're staying afloat, you have excess or surplus money now, learn about investment. We'll have a separate topic about investment, but there's a lot of things which you can invest on. One would be you can put money aside pre-tax through a 401k. You could invest in stocks, mutual funds. You can invest in real estate. There's a lot of other things which are out there, but you have to understand, because this is hard-earned money. Don't just pick and choose. That's why we're taking the time to understand and do it properly. Number 3, invest in yourself. You are the most important investment. You have to understand that working for yourself, for your improvement, would actually generate better revenue. Whether you take a master's degree or you start a business, not everyone is going to be, I wouldn't encourage everyone to actually go to business if they're not business savvy. But you have to work and move forward, because at the end, that would provide progress and prevent stagnation, so you can go up either the chain of the ladder, or even better, if you start own business. Lastly, which is their secret, is understand taxation. And this is going to be twice as important for people who do want to start business, because taxation basically is real money. When you get a tax deduction, the amount of income taxed is going to be lower than the amount of income earned because of those tax deduction. And what does that mean? Let's say if you earn $100,000 and you have $75,000 of tax deduction because of expenses, then the only tax you get is around the $25,000, and then you're shifted to that bracket, which is going to be a lot lower compared to $100,000. So see the difference? I hope you liked the video. Please click the like and subscribe button. And if you have any comments, feel free. I'd be happy to discuss it further. Or if you have any other topics that you want, let me know in the chat. Thank you.